Welcome back, everyone. My name is Dee.
And I'm Bob, the lizard. Today, Dee is going to talk about using stop losses and...
Hey, do you mind? Like, for years, I didn't even know you could talk, and now I can't get a word in edgeways.
Well, I've got a lot to say.
Yeah, all right. Can we do this another time?
Are you going to tell them what the video is about?
Yes, I'm going to tell them.
Well, go on then.
In today's video, we're going to talk about something I've touched upon before, using your stop losses. Specifically, is it ever okay to trade without a stop loss?
No.
Well, what if they trade options or they're doing long-term investments? Because then, on most investing platforms, the entire positioning is calculated as an absolute measure of stock going to zero. So that's your stop loss. Oh, now he's gone quiet. Can you go away? So, we're going to talk about trailing stop losses, including when is it okay, if ever, to move the stops to break even and when it isn't. So let's begin, if my friend Bob over there agrees.
Yup.
Let's do this. First up, right off the bat, a lot of you know that I'm not really in favor of moving stop losses. Whenever I hear someone saying that they move stop losses to break even, to protect their capital, after a brief conversation, we kind of get to the real reason why they're moving stop losses, and it's always some kind of a fear of loss or lack of confidence or a combination of both. Now, when we're writing our algorithms and trying to improve the performance, there is still always someone who suggests putting in a piece of code to move the stop loss to break even in an effort to try and control the drawdown, because that sounds logical, right? But what I found is that every time we tried to do that, it actually did very little for the drawdown, and yet it almost completely cut off the profit curve. And why? Well, it's because generally drawdowns are caused by being wrong somewhere in your approach and not by failing to take profits quickly. What happens usually is that you either got the direction wrong or the trade location wrong or both, and that is really what causes the drawdown. And that's a whole different problem than just not taking profits quick enough. So many traders, when they start losing often, they really get afraid of the losses. And then instead of going back to investigate the root problem of why you're losing, you go and start moving stops to break even or trailing them dynamically. But that is false economy. To illustrate with a quick practical example on one of my algorithms, I'm not going to bother you with like technobabble, but here's a relatively simple algorithm using the break of initial balance as the entry point and then using 2R multiple as a default target, meaning twice the amount of the initial stop loss. So if, for example, you're risking 30 ticks, the target would be 60 ticks. Now this algorithm already has some time-based optimizations as well as compounding on the position sizes because it uses a percentage of capital instead of just like one contract that you would normally start with on a fresh idea. And when you're testing a new idea, you really want to see what happens with the actual setup itself without a whole bunch of extra parameters cluttering up the place. And you know, every time you change something, whether it's the size of the contract or the size of the stop loss or time of day that you're entering, you're basically introducing extra parameters that can massively skew results. And it's the same thing as introducing moving stop losses to break even. So that's a quick back test of an existing algorithm. It's a setup that I teach in our level 2 of the pro development program. And it's an entry technique that I've consistently used for many, many years on various types of momentum-based trades across 3 types of asset classes. Now this is I think about 3 months of a back test. So it's a really good return on a rather aggressive setting to stress the algorithm. This one does trades in both directions on crude oil. So even though crude oil was largely in an uptrend at this time, if I show you the order tickets, you would see that quite a few of the sell profit orders got reached. So I'm not going to go through all of them. But if I just kind of start pushing, you will see final target short, and that kind of keeps happening. And that is because crude oil is slippery. it really does offer opportunities on both sides of the market on a lot of the days. So that's why crude oil is both tough, but it's also very technical and very rewarding if you know where to look and when to look, more importantly. Okay, so now I'm going to go and put in a code block that will move the stop loss to break even +1 when the trade reaches 10 ticks in profit. Ouch. So effectively you blow the account in about 3 weeks. That's less than a month. So why is that? Why isn't the break-even stop loss protecting your capital? In fact, it's doing the exact opposite. So let's compare some stats, because everything is about statistics when it comes down to it. On the algo, where I let it run to either full target or full stop loss, I have an average loss of 2.14% of the assigned capital. Now remember, there is a compounding block of code there. So as the account grows, so does the initial risk taken. So although this algorithm is set to use 0.85% per trade, as the account grew, that risk compounded to larger positions. However, this metric on the particular platform that I'm using here, it just takes in an average of all positions taken. And now let's look at the stats of our unfortunate break-even algorithm. The average loss is at 0.85%. So that's the only metric that's better. The rest of it is an absolute car crash. And yet, we know that this strategy is profitable and it works. However, because the trader decided that they're going to be all clever and started doing strategy design in an attempt to optimize their losses, the trader actually manages to trade themselves out of their entire account in the space of less than a month. You have shaken up confidence, blown account, psychological trauma, whole bunch of other negative stuff going on. And when that happens, the trader then decides to stop using this entry technique and moves on to the next thing. So I hope that this example perfectly illustrates how much damage you can cause to your trading account if you're just randomly switching around the rules of a particular strategy. Now, before I go on, if you are finding this video useful in any way, don't forget to press the like button and to subscribe if you're not already subscribed if you want to see more videos like these. All of that is a completely free way to support the Market Stalkers channel and to also help us spread the word about consistent, responsible trading. And also to make people realize that professional trading strategies are not just for the professionals. You can be a small trader just starting out, but that doesn't mean that you should also start with the usual flawed retail approaches of moving averages and RSI nonsense. In fact, one of the reasons why we started this channel is to provide regular traders, small traders, with information on what is a good strategy. We wanted to become suppliers of a reasonable, affordable way to start using order flow tools and strategies. And that's where our technology team Blahtech comes in with their super functional, professional, yet very cost-efficient tools. And same goes for my pro development program and all of my Udemy and Skillshare introductory courses. So by clicking on the like and subscribe, you're actually helping us get noticed by the YouTube algorithm. Yay! Anyways, let's get back to stop losses. So is there a time, what was that? Random shake. So is there a time when moving a stop loss to break even might be acceptable? There is, and that's in the following cases. Let's say you're doing one of the trader assessment challenges, either from Top Step or Earn to Trade, and let's say that it's not going that well. So now you're close to the daily loss limit, but you still have a bit of money left on the day, and you notice a star setup is developing. You decide to take a punt and enter because you're playing probabilities that you know have worked for you many times. Let's also say that the market jumps away in your favor pretty quickly. If that happens, in order for you to protect the challenge so that you don't bust the daily loss limit and that you don't have to pay another $100 for a reset, then it's okay to move your stop loss to break even and to remove that risk of blowing the assessment. The second time when it's okay to move a stop loss is maybe if you get a late fill or a bad fill if you're trading live with more contracts. And what I mean by that is, let's say you've been trying to obtain an entry into an obvious setup, but maybe you got distracted, maybe someone knocked on your door, maybe your kid needed attention, like whatever. So now you're back at your trading desk and the price moved further away than you expected. But you still pull the trigger, you still want to get involved. That's a part of a trader's life. And you do get a really decent move from this crappy entry price. So in that case, it's also acceptable to move the stop loss to break even. Now notice the pattern between these two situations. Both require that there's quite a bit of movement away from your entry price. If you don't have that, then statistically there is no point moving the stops. And I've shown you in a practical example just how destructive moving stop losses can be to your results. The reason for drawdowns is usually not traders being super ambitious with their targets and then having loads of profit and then giving the profits back in the same trade. The reason for losing too often is because either the trade locations are not good, or you're trading at the wrong time of day, or maybe your stop loss is too small for the market you're trading, so you get whipped out really quickly. But for both of these problems, you're not going to solve them by quickly moving the stop loss to break even, because you need to look at the deeper reason why that's happening. Otherwise, you will still continue to be wrong and you will continue having positions that never go into profit, which is why in the sad algorithm, the average loss is better, but everything else is worse. Because you've removed the potential for a statistically viable target that is absolutely needed to take your profit curve into positive territory. So you're not allowing your trade to actually go in your direction. It's like shooting yourself in the foot and then trying to run a marathon. It just doesn't work. Now, if you're not happy having a stop loss in the first place, there are other types of markets and trades that you can get involved with instead, like options. Option trades don't have a stop loss price. With long options in particular, your risk is limited to the premium that you paid on the option. So the price can wag around your strike price, go below it, go above it, and as long as the price crawls into profit at some point, the option will end up in some money. Obviously, this is a vast simplification because with options you have like a whole host of other kind of worms like time decay that erodes the long option profit. And I'm not going to be going into options trading. While I have traded options before, I'm far from an expert. Obviously, the better choice would be to actually figure out which part of your approach is hurting your performance the most and then to methodically work to improve that. That's it from me today. Don't forget to like and subscribe, and I'll see you guys next time. Click here for more trader issues and click here for reviews, day trading strategies, and busting the myths of profile trading. Goodbye.